Yeah, good morning, traders. Welcome to Navigating Markets. It's been a really big 12 or so hours in financial markets. It kind of is eerily reminiscent of 2020. People have been pricing in the idea of a higher propensity for lockdown. So we've seen that in Australia, a number of other countries as well. Are we going to see that in the US? I think the market's probably saying that there's a higher chance. I'm not so sure, but certainly the markets are anticipating that to be the case. The Delta variant has been the red flag, I suppose, for people to de-risk and degross their portfolios. And I think some of the leverage funds have clearly taken some off the table. There's probably been some gamma levels which have been breached and some hedging flows that have had to happen through optionality. So I think flow's been a large part of what we've been seeing as well. But at the heart of what we've been seeing is clear signs that Q2 growth numbers have slowed down from Q1. We know that's been the case. But the question has been is whether we're going to get a re-acceleration into Q3. And people have been positioned for a re-acceleration playing through as reopenings take place. Now, as the concern about lockdowns manifests, we have seen people looking to ratchet down their estimates down there, and markets are speaking out. So there's a lot of questions being asked of markets. There's not a lot of immediate answers, and we're seeing that playing through in people de-risking those portfolios. Let's go straight to the US bond market. This is telling everything you need to know. We've got the US 10-year treasuries down at 119 at the moment. So they're down fairly hard on the session, down 10 basis points. If we have a look at the curve, the 210s yield differential, which tells you everything you need to know, we've got the difference now between 2 and 10-year treasuries basically trading at 98 basis points. So that's down 8 or 9 basis points on the session. So it's in that bull flattening playing through. So the concern that we've got is that inflation is going to stay with us for some time. That's going to lead central banks into this kind of tricky, awkward situation where they don't really know what to do with policy because growth estimates have been falling. But at the same time, they've got this fairly sticky inflation, which is above target. It's kind of what we call stagflation. I don't really want to call this move stagflation, but the bond market is screaming at us right now that inflation is going to be with us for a longer period than most people anticipated. Growth estimates are coming down. It's arguably a bad situation for risk assets to be in that situation. It's what we call stagflation. Again, I don't necessarily think we're quite calling it that, but that's what the bond market's telling us at the moment. And I think other asset classes are feasting off that. Let's have a look at the commodity trade as well, because we just can't go past what's happening in the crude price. We've seen crude collapsing 7%. It had its biggest worst day since April 2020. Look, we know we've seen the OPEC agreement coming through. We know that they've agreed to extend or to about the output cuts, 400,000 barrels. I'm not so sure that that's the trigger. Look, it kept some buyers away, but I think what you're seeing here is a perception about falling demand because of lower Q3, Q4 numbers playing through. Ultimately, though, we have seen the crude price stop on a dime into this horizontal resistance or support levels into sort of 66.50. If we are going to see a dead cat bounce, or if we're going to see a bounce coming through, whatever you want to call this, coming through in risk assets, we're going to need to see the crude price being at the epicenter of that because that's so integral to the sort of global risk on sentiment playing through and this re-acceleration rally. So, crude prices do sort of drop through these levels. That could be bad. That could take risk down another level. But if we do see a bounce back in that, then that could be positive. Let's go into equity markets. Yeah, we've seen the S&P close down 0.64%. Again, we're just holding this horizontal support level. We saw the gap down in the cash trade, and the markets are just holding on there. Now, we did trade down into sort of 42.33. And if we go to the 5-minute chart, you can have a clear see. Everything's obviously you've seen this de-risking in portfolios. But I think the bulls, if you're going to see anything there, it's the fact that we've had this move from 42.34, 32.43 into 42.59 in that last half an hour or so. Markets that close on their low tend to trade lower going forward. The fact that we've seen this modest bid that came back into the market in the end of the day is something that the bulls will actually savour, I suppose. Now, if we have a look at the sectors, we can see all sectors lower. It has been a very defensive day. I don't think it's going to take a genius to work that one out. Energy down 3.6%, financials down 2.8%. They just really can't take a trick, financials at the moment. We need to see a situation where that yield curve starts steepening, 10-year yields start underperforming and moving up more gradually relative to 2 yields, and then financials will fly. That may well take place as we go into the Fed meeting, as we go into payrolls. We'll have to see. But you can see here from the sectors, it's not been a particularly good day. The space where we have seen some buying, probably your work from home stocks, they've obviously outperformed. Surprisingly, you've seen Tesla and GameStop doing quite well on the trading session there, but that's one to watch. With the commodity trade here, let's have a look at copper price. Let's take it off the 5-minute chart here, and we can see obviously the big move down there. So price was really just trying to break and trying to find some sort of form above 432. But we've seen this reversal playing through there. Big move down to the downside, 2.5%. We've taken out these series of lows. It looks like this may want to head lower in the short term. I'm not prepared to trade it by any means at all, but the fact that copper's down really sort of amplifies this idea that what you're seeing there is an economic fragility shock playing through in financial markets that we just can't quite price at the moment. Let's go into FX markets. The dollar has outperformed. It's been a safe haven bid there. So the dollar, Swiss franc, Japanese yen, all outperforming. Immediately, of course, in this risk-off environment, this classic risk-off environment, I'm going to Aussie yen, which you can see here has had a big move down 1.2%. We've taken out the 200-day moving average. This is trending now. So rallies are to be sold in Aussie yen, in my opinion. With the lockdowns that we're seeing across Australia, which are being extended all the time, this is going to hit consumer behaviour. Its sentiment's obviously going to be taken down. We've already seen signs of that playing through. The Aussie's looking a bit vulnerable at the moment. The idea that potentially they could come out with a slightly even more dovish turn going forward is something that's keeping the Aussie underpinned. Aussie dollar, the weakest levels really we've seen since the back end of last year. That's obviously something that's keeping there. So your growth proxy currencies are doing pretty poorly. We've been looking at Aussie CAD recently, dollar CAD recently, and dollar CAD is moving nicely to the upside there. We're through the 200-day. This just looks absolutely breathtaking from the long side at the moment. So again, your Aussies, your CADs, your Kiwis, if they're finding form to the downside against your proxies of risk, so Aussie against the yen and the Swiss franc and against the US dollar as well. So we're in an environment at the moment where you're clearly seeing that growth being called into question. When are we going to get answers to that? I personally think that the market's being too pessimistic on this. Are we prepared to trade it and put risk on at the moment? I'm not so sure, but you're clearly seeing a de-risking, a degrossing playing through with a lot of questions being asked. But yeah, more to play through and just be careful of these situations at the moment. We are seeing some trends coming lower in a lot of these risk assets, and my preference in the short term is probably to trade with that.